Major turning points in financial history rarely announce themselves with blaring alarms or flashy headlines. They happen quietly, often buried in technical data that few people outside of institutional finance ever see. By the time the public catches on, the big move has already happened, the smart money has taken its positions, and the price has already adjusted. That's exactly the kind of moment the silver market seems to be going through right now. Something unprecedented has occurred behind the scenes, something that fundamentally changes how this market works. And it involves the very institution that, for decades, symbolized silver suppression, not optimism. The same global bank long accused, fined, and documented for holding massive short positions designed to cap silver prices has just executed one of the most dramatic reversals ever seen in a commodity market. They have quietly abandoned their paper suppression strategy and shifted aggressively into physical ownership on a scale that defies historical comparison. This isn't rumor or internet hype. It's based on reported position data, vault movements, delivery records, and official market disclosures. Together, they paint a picture that is deeply uncomfortable for anyone still assuming silver trades like a normal commodity. Here are the facts. Between mid-2025 and late 2025, JP Morgan Chase eliminated its entire massive paper short position in silver, an exposure estimated at roughly 200 million ounces. At the exact same time, it began accumulating physical silver at a pace never before seen in modern markets. It has now amassed an estimated 750 million ounces of actual deliverable metal. Not futures contracts, not ETF shares, but real, solid bars stored in controlled vaults. That amount is roughly equivalent to an entire year of global mine supply. And when you grasp what that implies, the logic is impossible to ignore. This isn't a hedge fund making a speculative bet. This is a systemically important global bank deploying tens of billions of dollars of its own capital to secure physical supply. They are doing this ahead of what they clearly believe is a structural breakdown in the existing silver pricing mechanism. To understand why this is so significant, you have to understand how silver has been priced for decades. It hasn't been priced by physical supply and demand. It's been priced by paper contracts traded on exchanges, where the volume of paper claims routinely exceeds the available physical metal by huge multiples. This structure only works as long as most traders accept cash settlement and don't actually ask for the metal. The moment too many players demand physical delivery, the whole system breaks down. And that moment appears to be approaching fast. The first major signal that institutions watch is stress in the physical lending market. In late 2025, silver lease rates, the cost to borrow physical silver, surged dramatically. They hit levels almost unheard of in a functioning commodity market. These aren't rates for normal business. These are rates that imply desperation. When lease rates spike, it means physical holders are refusing to part with their metal, even temporarily. And it means borrowers are willing to pay extreme premiums just to get their hands on it. This only happens when inventories are thin and the risk of not getting delivery is rising. At the same time, the inventories that actually matter for price discovery, the registered stocks on futures exchanges eligible for delivery, have been steadily drawn down to multi-year lows. Yet open interest, the number of outstanding paper claims, remains high. This creates a dangerous situation where multiple owners are effectively promised the same single ounce of silver. It's a game of musical chairs that works on paper but collapses the moment confidence erodes. And confidence is exactly what disappears when runaway industrial demand collides with a constrained supply. Unlike investment demand, which can pause during economic downturns, industrial demand doesn't stop just because prices rise. Silver isn't a luxury for modern technology. It is a critical, irreplaceable material. It's embedded deep inside our energy systems, electronics, transportation, and communications infrastructure. In 2025 alone, industrial applications consumed well over 1 billion ounces of silver globally. This was driven primarily by solar panel manufacturing, electric vehicle production, advanced electronics, data centers, and 5G network infrastructure. The key detail most people miss is that these consumption patterns are locked in years in advance through long-term contracts. Manufacturers can't just switch to another material or delay their purchases without disrupting entire global production lines. Silver's unique electrical and thermal properties make it extremely difficult and expensive to replace. While this demand has been accelerating, supply has not kept pace. Global mine production has remained relatively flat for years. This is due to declining ore grades, long lead times for new projects, and the fact that most silver is produced as a byproduct of mining other metals like copper, lead, and zinc. This means supply can't respond quickly to higher prices. The result has been consecutive annual deficits, where far more silver is consumed than is mined. This forces the market to draw down above-ground inventories to fill the gap, inventories that are now visibly shrinking. This is where the institutional shift by a player like JP Morgan becomes perfectly logical. When a bank that has spent decades profiting from paper dominance suddenly abandons that strategy and moves aggressively into physical accumulation, it's a powerful signal. It tells you their internal models no longer believe paper mechanisms can contain the price. The suppression game only works as long as there's enough physical supply to satisfy delivery demands when stress appears. The moment that buffer vanishes, the risk flips from manageable to existential for anyone short on metal they can't source. This explains why the same institution that once capped rallies is now positioned to profit from rising prices. They have done the math, they see the endgame, and they have repositioned accordingly. The timing of this shift is not random. It coincided with visible strain across the entire physical market, from retail shortages at sovereign mints and delivery delays for large buyers, to rising premiums and even temporary freezes in liquidity in major trading hubs. This revealed that the metal reported on balance sheets is not as readily available as the paper accounting suggests. Much of it is encumbered, leased out, or already allocated to exchange-traded products, creating a fractional reserve structure where the same physical bars back multiple paper claims. This system functions smoothly only until someone big insists on taking physical delivery at scale. When that happens, markets don't adjust gradually, they seize. Institutions that understand this don't wait for headlines. They move early, quietly, and decisively. That is exactly what has happened here. This accumulation wasn't announced in a press release or promoted in an ad campaign. It was executed through quiet vault transfers, delivery stops, and off-market sourcing, the kind of behavior that signals preparation, not speculation. Many people compare this to the Hunt brothers' attempt to corner the silver market in 1980, but that comparison is misleading. The Hunts used leveraged futures positions, making them vulnerable to rule changes, margin hikes, and forced liquidation. Physical ownership funded with a bank's balance sheet is structurally different. There's no margin call on metal you own outright. There's no forced sale triggered by exchange rules. A physical holder can simply sit and wait for the price to adjust to the reality of scarcity. When you combine that reality with industrial users who cannot stop buying and mine supply that cannot surge, you arrive at an unavoidable conclusion. Price becomes the only variable left to balance the market. When supply is fixed and demand is inelastic, the price must rise high enough to ration usage. That is the scenario institutions now appear to be positioning for. Not a short-term spike, but a structural repricing where silver transitions from being treated as abundant on paper to being recognized as scarce in reality. This repricing doesn't require a market collapse. It simply requires enough participants to prefer physical settlement over a cash payout. That shift in preference often happens suddenly, once confidence breaks. And confidence breaks not when prices rise, but when delivery fails or becomes uncertain. Markets are built on trust first and liquidity second. When trust erodes, liquidity vanishes instantly. This is why the rising lease rates, falling inventories, persistent deficits, and massive institutional accumulation matter far more than day-to-day price noise. They reveal the immense pressure building just beneath the surface. The most important signal of all is not what small retail investors are doing. It's what the largest, most informed players are doing with their own capital. Institutions do not deploy tens of billions of dollars into a physical asset lightly, especially one they once actively suppressed. They only do that when their internal analysis shows that the risk of not owning it far outweighs the risk of price volatility. That calculus appears to have flipped decisively. This suggests that silver is no longer viewed internally as a manageable paper market, but as a constrained physical resource facing years of structural demand growth. When that recognition spreads beyond a small circle of insiders, price discovery doesn't proceed gradually. It resets. Paper claims cannot create metal, and derivatives cannot power our solar grids or data centers. Eventually, the physical world always asserts its dominance over financial abstractions. This leaves us with a simple but uncomfortable question, not whether silver will be volatile, but whether current prices still reflect a system that no longer functions as advertised. History shows that when markets transition from perceived abundance to actual scarcity, the most violent price moves occur not at the beginning of the trend, but at the moment the recognition of that scarcity becomes widespread, when everyone suddenly realizes that what they thought they owned on paper may not be available in reality. By then, the institutions that moved first are already positioned, already supplied, and already waiting. Thanks for watching, and be sure to subscribe for more updates.